The United States just crossed $35 trillion in national debt, and it's accelerating faster than at any point in American history. But here's what's truly terrifying, and what almost no one is talking about. The people who think they're protected because they hold silver, maybe the most unprepared of all. Stay with me, because in the next 12 minutes, I'm going to show you exactly why and what you need to do before it's too late. Welcome back. If you're new here, this channel covers one thing: hard truth about money, gold, and silver. No sugarcoating, no mainstream spin. Today, we're diving deep into something that affects every single person watching this, whether you're in Germany, France, the UK, the Middle East, or anywhere else that holds US dollars in reserve. America's debt spiral is no longer a future problem. It is happening right now, and the ripple effects are about to slam into silver markets in ways that most retail investors are completely unprepared for. We'll cover the debt mechanics, what the Fed and ECB are actually doing behind closed doors, the COMEX data that should alarm you, and critically, 3 scenarios for what happens next to silver. Let's get into it. Let's start with raw numbers, because the scale of what's happening is hard to comprehend. The US national debt has now surpassed $35.8 trillion, but that headline figure is almost misleading because the rate of accumulation is the real story. America is adding approximately $1 trillion to its debt every 100 days. Not every year, every 100 days. Interest payments alone on that debt now exceed $1.1 trillion annually, more than the entire US defense budget, more than Medicaid. The United States is now the first major economy in history to spend more servicing its debt than on its own military. Now, pay attention, because this changes everything. When a country reaches this point, it faces exactly 2 exits, and neither one is painless. Exit 1, default politically impossible and economically catastrophic. Exit 2, inflate the debt away, print money, devalue the currency, and quietly transfer wealth from savers to the government. This is the path every empire in history has chosen when the debt becomes unmanageable. And this second exit? It is the single most powerful bull case for silver that has ever existed. Here's what the big banks and mainstream financial media don't want you to understand clearly. The Federal Reserve is caught in an impossible trap. If they raise rates further to fight inflation, they explode the US government's interest payments even higher, making the debt crisis worse. If they cut rates to stimulate the economy, inflation reignites, destroying purchasing power. They have no good option. And the market is starting to figure this out. But here's what almost nobody is telling you about the ECB side of this equation. The European Central Bank is facing its own parallel crisis. The Eurozone is still carrying the scars of years of negative interest rate policy, bloated sovereign debt in Italy and France, and an industrial base that has been hollowed out by the energy crisis. What does this mean in practical terms? It means both the dollar and the euro are under structural debasement pressure simultaneously. For the first time in modern history, there is no major fiat currency offering a genuine safe harbor. When the dollar weakens and the euro weakens at the same time, capital has to go somewhere. Historically, and this is a pattern that repeats without exception across centuries, that capital flows into gold first, then silver. Gold moves first because institutions move first. Then silver explodes upward as retail demand follows, industrial demand intensifies, and supply struggles to respond. We are in the early stages of that rotation right now. Let's talk about the COMEX, the commodity exchange in New York, because the data coming out of there right now is extraordinary, and it is being almost entirely ignored by mainstream financial media. COMEX silver registered inventories, that is physical silver that is actually available for delivery, have been declining sharply over the past 18 months. At the same time, open interest on silver futures contracts remains historically elevated. What does that mean in simple terms? It means there are far more paper claims on silver than there is physical silver to back them. Some analysts estimate the ratio of paper silver to physical silver at somewhere between 150 to 1 and 300 to 1. That is not a typo. For every ounce of real physical silver in the registered vaults, there may be up to 300 ounces worth of futures contracts and derivatives written against it. Now here's the critical question. What happens when confidence in paper silver breaks, when enough buyers demand physical delivery instead of cash settlement? History gives us the answer. It happened in 1980. It happened in 2011. And when it happens again, and the data strongly suggests we are closer to that moment than most people realize, the price movement in physical silver will be violent and rapid. The silver holders who are not ready are those sitting in silver ETFs, paper certificates, or unallocated accounts. If the COMEX cracks, those instruments may not perform the way investors expect. Allocated, physically held silver is a completely different story. Here's the dimension that most precious metals channels underestimate when they talk about silver. Silver is not just a monetary metal. It is an industrial critical mineral, and the industrial demand picture has fundamentally shifted in the last 3 years. The global push towards solar energy, electric vehicles, and advanced electronics has created a structural demand surge that was simply not present in previous silver bull markets. A single solar panel contains roughly 20 grams of silver. The International Energy Agency projects that solar capacity will need to triple by 2030 to meet global climate targets. The arithmetic on silver demand from solar alone is staggering. Add to that EV power electronics, 5G infrastructure, medical devices, and defense technology, all heavily silver dependent. Meanwhile, silver mining output has been essentially flat for years. New mine development takes a decade and billions in capital. There is no quick supply response. This is the collision course. Exploding industrial demand meeting constrained supply at exactly the moment monetary demand is accelerating due to currency debasement. This is what makes this moment genuinely different from previous silver cycles. Let's zoom out for a moment. Central banks around the world, particularly in China, India, Turkey, Poland, and across the Gulf states, have been buying gold at the fastest pace recorded since the 1960s. In 2022 and 2023, central banks collectively purchased over 1,000 tons of gold per year levels, not seen in over half a century. Why does this matter for silver? Because central bank gold buying is the ultimate signal. These institutions have access to information and analysis that no retail investor will ever see. When they accumulate gold at this pace, they are making an explicit statement. They do not trust the long-term stability of the dollar-based financial system. And historically, without exception, when gold breaks to new all-time highs driven by institutional and sovereign buying, silver follows with a much larger percentage move. Gold leads, silver multiplies. So let's bring this all together and look at what actually happens from here. I'm going to give you 3 scenarios: base case, bull case, and the scenario almost nobody wants to talk about. Scenario 1, the controlled landing base case. The Fed manages a soft landing. Inflation drifts back toward 3%. Rate cuts begin gradually. The dollar weakens moderately. Silver grinds higher, reaching $38.45 per ounce over 12-18 months. A solid gain, but not dramatic. Silver ETF holders do fine. Physical holders do fine. Scenario 2, the inflationary break bull case. Inflation reaccelerates due to energy shocks, geopolitical escalation, or fiscal stimulus. The Fed is forced to choose between crushing the economy with rate hikes or letting inflation run. They let it run. Dollar confidence erodes sharply. Silver demand spikes. COMEX stress increases. We see $60, $85 silver within 18-24 months. Physical silver holders benefit enormously. Paper silver holders face counterparty risk. Scenario 3, the dollar confidence crisis, tail risk, a U.S. debt downgrade, a treasury auction failure, or a geopolitical shock triggers a rapid loss of confidence in dollar-denominated assets. Capital floods into hard assets globally. The COMEX system faces a delivery crisis. Silver goes into price discovery mode, meaning nobody really knows where it stops. This is the scenario the financial establishment calls impossible right up until the moment it happens. The probability distribution across these 3 scenarios is shifting. Scenario 1 is becoming less likely. Scenarios 2 and 3 are becoming more likely with each passing month. Let's summarize what we've covered today. America's debt is compounding at a rate that is, by any historical measure, unsustainable. The Fed and ECB are both trapped between inflation and recession. COMEX registered silver inventories are declining while paper claims multiply. Industrial demand from solar, EVs, and technology is structural and growing. Central banks are sending the loudest possible signal by buying gold at generational pace. And the 3 scenarios ahead of us all point to varying degrees towards silver as a critical asset to hold. Here is the clear, direct recommendation. If you hold silver in any form, understand what form you hold it in. Allocated physical silver coins, bars, stored securely, is not the same as an ETF share or a paper certificate. Know the difference. The difference matters most precisely when it matters most. If you do not yet hold silver, the window of relative calm we are currently in, before this debt story fully breaks into mainstream consciousness, is historically the time to act. Now, here's what I need from you. If this video gave you clarity, hit the subscribe button and turn on notifications. We cover these markets every week with the same level of depth. Drop a comment below with the word silver. It tells me you want more content like this, and it genuinely helps this channel reach more people who need to hear this information. And if you know someone, a family member, a colleague, anyone who keeps their savings entirely in cash or in a bank account, share this video with them. You may be doing them a genuine service. The debt bomb has a fuse. Nobody knows exactly how long it is, but the clock is running.